Imagine two people who finally reach the point everyone tells them they should be proud of. Jake has $500,000 invested. Marcus has $500,000 too. Same age, same income, same city, same starting net worth. Jake looks at his $500,000 and says, "I've waited long enough. It's time to upgrade my life." He buys the expensive house, takes on the larger monthly payment, and starts living like someone who's already made it. Marcus does almost the opposite. He keeps his ordinary house, keeps his lifestyle almost unchanged, and puts the majority of his new money into investments. They both think they made the smarter choice. They're both wrong. Because the biggest wealth mistake people make between $500,000 and $2 million isn't necessarily buying a house. It isn't necessarily spending money. And it isn't even necessarily investing too aggressively. The mistake is changing the way you think about money before your money has finished changing your life. And the gap between these two people is going to get surprisingly large, so let's make this fair. Jake and Marcus are both 42. They live in Dallas. They each earn $140,000 a year. They each have $500,000 in net worth, with $400,000 invested and $100,000 in cash and other assets. Neither has inherited money. Neither gets a magical promotion. And for this comparison, both increase their annual savings by 3% as their salaries rise. Now watch what happens when $500,000 stops being treated as a foundation and starts being treated as permission to spend. Jake buys a $650,000 house. He puts $130,000 down, leaving a $520,000 mortgage. Assume a 5% 30-year fixed rate. His principal and interest payment is roughly $3,287 a month. Then add property taxes, homeowners insurance, and maintenance. At roughly $9,100 a year in property taxes, $2,400 in insurance, and a maintenance reserve of about 1% of the home's value, another $6,500 a year, Jake is looking at roughly $4,787 a month before utilities. His old housing cost was $2,400 a month, so the lifestyle upgrade isn't $1,000 a month. It's roughly $2,387 more every month. That's $28,644 every year. And here's the part people miss. Jake doesn't just spend that extra $28,644. He also takes $130,000 that could have remained invested. Marcus doesn't buy the $650,000 house. He keeps his existing home, spends roughly $2,400 a month on housing, and invests the difference. Feelings and math are two very different things. On day one, Jake has the house. Marcus has a number on a screen. Jake can walk into his kitchen and see where the money went. Marcus can't. That matters psychologically. Now, let's go to year one. Jake has made roughly $28,644 in additional annual housing-related cash outflow compared with Marcus. His mortgage balance has fallen only modestly, while the property may have appreciated. Let's assume the house rises 3%. On paper, that's about $19,500 of appreciation. Sounds great until you subtract everything else. Jake has paid roughly $57,400 in mortgage principal and interest during the first year. Only about $3,000 to $4,000 of that is principal. He has also paid approximately $9,100 in property taxes, $2,400 in insurance, and $6,500 in maintenance reserves. And he gave up $100 in insurance and property taxes. Marcus, meanwhile, takes that $130,000 and invests it. He also invests the roughly $28,644 annual lifestyle difference. Assume a 7% long-term investment return for the comparison. After 1 year, Marcus's additional invested money is already around $170,000 before considering his original $400,000 portfolio. Jake's house may have gained $19,500. Marcus's portfolio may have gained roughly $12,000 on the new capital. So Jake appears to be ahead. That's exactly where the trap begins. Because Jake is looking at the house price. Marcus is looking at the balance sheet. Year 3. Jake's house, assuming 3% annual appreciation, is now worth around $710,000. His mortgage balance is roughly $497,000. That gives him about $213,000 in home equity. Sounds great. Until you remember the $130,000 down payment, the interest paid, property taxes, insurance, maintenance, and the investment growth he gave up. On paper, that's $213,000 of equity. Sounds great until you subtract everything else. Marcus has continued investing the original $130,000 and the annual cash flow difference. At a 7% return, the original $130,000 alone has grown to roughly $159,000. The additional annual investments have accumulated to roughly $92,000. So the incremental investment account is approaching $251,000, and that doesn't include Marcus's original $400,000 portfolio. Now something important happens. The story begins to reverse. Jake has a bigger house. Marcus has a bigger liquid investment account. Jake feels richer. Marcus is actually becoming more financially flexible. But we're only 3 years in. Let's go to year 5. Jake's house reaches approximately $753,000 if it appreciates at 3% annually. His mortgage balance is around $479,000. His home equity is therefore about $274,000. That's a $144,000 increase from his original $130,000 down payment. On paper, that's $274,000. Sounds great until you subtract everything else. Over 5 years, Jake has paid roughly $197,000 in mortgage payments. A large portion was interest. He has also paid around $45,000 in property taxes, $12,000 in insurance, and potentially $30,000 to $40,000 in maintenance and repairs, depending on the property. And there are transaction costs waiting at the other end. If Jake sells, a rough 5% to 6% selling cost assumption could mean $38,000 to $45,000 disappearing from the sale proceeds on a $753,000 property. The house isn't fake wealth. The equity is real. But equity isn't the same thing as spendable wealth. Marcus's side looks different. His original $130,000 investment at 7% for 5 years becomes roughly $182,000. His additional annual investment of around $28,644, increasing with his income, grows to roughly $165,000. That's approximately $347,000 from the decision to keep the money invested rather than upgrading the lifestyle. And again, that's just the difference created by the housing decision. Marcus still has his original $400,000 investment portfolio. If that portfolio compounds at 7%, the original $400,000 becomes roughly $561,000 after 5 years. Add the new investment capital, and you're around $908,000. Jake's original $400,000 portfolio hasn't disappeared, but because he diverted capital and cash flow toward the house, his investment account is much smaller than it otherwise could have been. Let's say his remaining invested assets are roughly $220,000 after the down payment and the higher lifestyle costs. At 7%, that's around $309,000 after 5 years before additional savings. So Jake can look around at a $753,000 house and feel like he's doing better. Marcus can look at roughly $908,000 in financial assets and feel like he's doing nothing. That's the psychological problem with wealth building. The thing that looks impressive isn't always the thing doing the most work, and the thing doing the most work often looks boring. A house doesn't show you compound interest happening overnight. An investment account doesn't give you a bigger kitchen. Jake gets the tangible reward. Marcus gets the invisible machine. And now we're approaching the most dangerous stage of all. Because once someone crosses $500,000, they start hearing a different kind of advice. You've made it. You can afford it. You deserve the upgrade. What's the point of having money if you don't enjoy it? None of those statements are automatically wrong, but they become expensive when you confuse having $500,000 with being financially independent. Because $500,000 invested at 7% doesn't just represent $500,000. Without adding another dollar, it can grow to roughly $983,000 in 10 years, and to roughly $1, $93 million in 20 years. That's the part Jake and Marcus were actually deciding on at age 42. They weren't just deciding whether to buy a bigger house. They were deciding what their $500,000 would be allowed to become. And at the halfway point of our timeline, That difference is just beginning to show. Year 10 is where the difference becomes impossible to ignore. Jake's $650,000 house, growing at 3% a year, is now worth roughly $874,000. His mortgage balance has fallen to around $407,000, so his home equity is approximately $467,000. On paper, that's $467,000. Sounds great until you subtract everything else. Over those 10 years, Jake has paid roughly $394,000 in mortgage payments, around $100,000 in property taxes, about $25,000 in insurance, and potentially $65,000 to $90,000 in maintenance and repairs. And remember the $130,000 he put down? The house didn't cost him $650,000. The financial decision was much larger than the purchase price. Now look at Marcus. The $130,000 he kept invested at 7% becomes roughly $256,000. The annual cash flow difference invested consistently can grow to roughly $390,000, and his original $400,000 portfolio becomes approximately $787,000. That puts Marcus around $43 million in financial assets before even counting his existing home equity. Jake, meanwhile, may have roughly $600,000 to $700,000 in investments, depending on exactly how much of his cash flow he redirected, plus approximately $467,000 of home equity. The gap isn't just about who owns more assets, it's about what those assets can do next. Marcus has $4 million working in liquid investments. Jake has a large portion of his wealth tied up in one property, and that creates our flip point. At $500,000, Jake's decision felt reasonable. At $1 million, it still looked reasonable. But somewhere between those two milestones, the compounding machine Marcus built became more powerful than the lifestyle upgrade Jake bought. That's the hidden mistake. People don't realize that the $500,000 to $2 million journey is where every financial decision gets amplified. When you have $50,000, a $5,000 mistake hurts. When you have $500,000, a $50,000 mistake can become a six-figure mistake after compounding. And when you're approaching $2 million, the biggest expense may no longer be the money you spend. It may be the return you prevent that money from earning. Now, let's talk about the number everybody brags about. Net worth. Someone says, my house is worth $900,000. Someone else says, I bought it for $600,000. Someone hears that and thinks they made $300,000. But that isn't the complete number. The first hidden layer is interest. Jake's $520,000 mortgage at 5% doesn't simply cost him $520,000. If he keeps that mortgage for the full 30 years, the scheduled principal and interest payments total roughly $18 million. That's about $660,000 of interest. Obviously, Jake can sell or refinance before then. But the point is simple. The interest rate isn't decoration. It's a real expense. The second hidden layer is maintenance. A common planning assumption is around 1% of a property's value per year. On a $650,000 house, that's $6,500 annually. Over 10 years, that's $65,000. Some years might cost $2,000. Another year might cost $18,000 because the roof, HVAC system, plumbing, or appliances decide to collect their paycheck at the same time. The third hidden layer is property tax. At roughly $9,100 a year in our example, Jake spends about $91,000 over 10 years before accounting for changes in assessed value or local tax rates. That's money that doesn't become equity. It's the price of owning the property. The fourth hidden layer is insurance. At $2,400 a year, that's another $24,000 over 10 years. And that number can change dramatically depending on location, coverage, deductibles, and insurance markets. The fifth hidden layer is selling friction. If Jake eventually sells that $874,000 property and pays roughly 5% in combined selling costs, that's about $43,700 gone before he sees the proceeds. The IRS also makes an important distinction here. A qualifying taxpayer may be able to exclude up to $250,000 of gain on a main home sale or up to $500,000 for qualifying married couples filing jointly, subject to the ownership and use rules. And mortgage interest can qualify for an itemized deduction within the applicable rules and limits. The IRS currently states that for homes acquired after December 15, 2017, the home acquisition debt limit for this deduction is generally $750,000 or $375,000 for married taxpayers filing separately. Those are real benefits. But notice what the IRS doesn't say. It doesn't say your house is free. A deduction doesn't erase an expense. A tax benefit can reduce the cost. It doesn't make the cost disappear. And this is where I need to be fair. If I only showed you the downsides of buying the house, I'd be doing what every one-sided financial influencer does. Jake isn't stupid. His house could outperform our 3% assumption. If it appreciates at 5% instead of 3%, that $650,000 property becomes roughly $1. 0.6 million after 10 years instead of $874,000. That's a difference of almost $190,000. That's meaningful. Jake also gets something Marcus doesn't get from his portfolio: leverage. Jake controls a $650,000 asset with $130,000 down. If the property rises 5%, that's a $32,500 increase in property value on the first year, before costs. His $130,000 equity can benefit from the appreciation of the entire property. Stocks don't give you that kind of built-in mortgage leverage unless you deliberately borrow, which introduces a completely different level of risk. Jake also gets housing stability. Marcus can watch his investment account fall 25% during a market downturn. Jake doesn't wake up one morning and find that his kitchen is suddenly worth 25% less because the stock market opened badly. And there are situations where Jake's decision can absolutely win. If comparable rent for that $650,000 house is $4,500 a month, while his all-in ownership cost is close to that amount, buying becomes much more competitive. If Jake stays for 15 or 20 years, his transaction costs get spread across a much longer period. If the property appreciates substantially faster than our 3% assumption, the math changes. And if the house provides a legitimate financial benefit, such as a rentable room, an accessory dwelling unit, or a house hacking opportunity, the cash flow can materially improve the equation. That's why the lesson isn't never buy the house. The lesson is, don't stop doing the math because you finally have money. Now let's take the story all the way to year 20. Suppose Jake's home continues appreciating at 3% annually. That $650,000 house becomes approximately $1. 17 million. His mortgage is now close to being paid down dramatically, leaving perhaps $125,000 to $150,000 depending on the exact amortization and timing. So his home equity could be around $1 million. That sounds enormous. And it is. But Marcus's $500,000 starting net worth has had 20 years to compound. His original $400,000 investment portfolio at 7% becomes approximately $1. $55 million. The $130,000 that wasn't used as a down payment becomes approximately $503,000. And the annual cash flow difference, invested consistently, can become well over $1 million. Even after allowing for taxes, changing expenses, and imperfect returns, Marcus can plausibly be in the $3 million plus range, while Jake may land closer to the $2 million range, depending on how much additional saving he manages and how the home performs. This isn't a promise. It's a model. Change the return, change the home appreciation, change the tax situation, change the maintenance, change the holding period. The result changes. But the mechanism doesn't. Compounding rewards capital that stays invested. Now, here's the lever that can completely change Marcus's side. Imagine Marcus invests just $200 more per month for 20 years. At 7%, that extra $200 monthly contribution grows to roughly $104,000, $200 per month. One small decision repeated for 20 years creates a six-figure asset. That's why the path from $500,000 to $2 million is so different from the path from $0 to $500,000. You're no longer trying to build the machine. You're trying not to interrupt it. So here's the practical playbook. First, when your net worth crosses $500,000, separate lifestyle money from compounding money. Decide how much you can safely spend without reducing your long-term investment contribution. Second, whenever you're considering a major purchase, calculate the full annual cost, not the monthly payment. Mortgage payment, taxes, insurance, maintenance, fees, opportunity cost, and the return that capital could have earned somewhere else. Third, run the decision over 10 and 20 years, not 1 year, not the first month, not the moment you walk through the front door. 10 years, 20 years. Because wealth decisions are often boring at the beginning and enormous at the end. And there's one more test I want you to use. Ask yourself, if nobody could see this purchase, would I still make it? If the answer is no, you may not be buying an asset. You may be buying a signal, and signals are expensive. Jake and Marcus both walked away thinking they made the smart play. Jake believed he had finally earned the right to enjoy his success. Marcus believed he was being disciplined by keeping his lifestyle modest. But neither one actually ran the full numbers. Jake calculated the house payment. He didn't calculate the opportunity cost of the down payment. Marcus calculated the investment return. He didn't fully calculate the value of housing stability and leverage. And that's the point. The real trap isn't the house. The real trap isn't the stock market. The real trap is making the decision based on hype, headlines, or someone else's opinion instead of running the numbers for your own situation. Because between $500,000 and $2 million, your money is finally large enough that small decisions stop being small. A $500 monthly difference can become hundreds of thousands of dollars. A $100,000 opportunity cost can become several $100,000. A 1 percentage point difference in long-term returns can completely change where you finish. And the most dangerous part is that the wrong decision often feels better at the beginning. That's why you can't judge a wealth decision by how it feels on day 1. You have to ask what it becomes on day 3,650. If you're wondering what happens when someone reaches $2 million and makes the exact opposite mistake, thinking they can suddenly stop investing because they've made it, that's a completely different conversation. Jake and Marcus started with exactly the same $500,000. They had the same age, the same income, the same city, but they treated that $500,000 differently. One treated it as permission to upgrade. The other treated it as a machine that still needed time. Neither approach is automatically right, but only one question tells you which decision makes sense for you. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Money Mindset Lab and hit the notification bell. We break down the hidden math behind the financial decisions you face every day.